Right, today's live, and it's my second live ever, so bear with me a bit. Today's live is going to be about something that's back in the headlines and likely to be there for a few more months still, and that is tariffs. It's easy to feel unsettled when you see the markets reacting, and I completely get it. But today I want to show you why I'm not panicking and why smart investors are not panicking either, and why understanding the markets and how they behave over the long term is one of the most powerful financial skills you can have. I've got my notes here, so I wanted to talk to you about something specific and not miss anything. So that's why I'm going to go off. But here's the quick agenda. This is what I want to cover today. I want to cover what tariffs are and why they create noise, why volatility is normal and not a reason to panic, what the real numbers show about why investing over the long term matters, and how I personally am reacting to this. All right, so let's start with what tariffs are and why they cause headlines. Tariffs are basically taxes on imported goods. So any goods coming into a country, if taxes apply to them, then that's what a tariff is. Governments use them to protect local businesses or gain an edge in delicate negotiations. But when tariffs go up, markets often get jittery because businesses face higher costs and there's a lot of uncertainty that's created. But tariffs are just one of the many events that create short-term noise. They don't change the bigger forces driving markets over decades. And the reality is that volatility happens for various reasons. It always has and it always will. Throughout your investing lifetime, you're going to experience many ups and downs and a lot of turbulence. But that's part of the course. That's what you sign up to when you say to yourself, I want to become an investor. Over the past 50 years, stocks have fallen by more than 20% on eight separate occasions. 8, that's a lot. The investors who lose out during these times are the ones who panic sell, locking in their losses. I mean, think about it. If you didn't sell and you waited for the market to recover, even though you might currently be thinking it might go further down, if you just stayed in, would you lose any money? Or would it just look like a bit of a digital loss on a screen somewhere? The second group who loses out are the ones that never invest at all. These are the ones that are sitting on the sidelines waiting for that perfect time. That perfect time doesn't really show up. But for those who stay invested, the rewards over decades have been significant. Let me paint you a picture why. If you would put, say, £100 into a global stock market index fund 50 years ago, and I know we're talking about what ifs here, but if you had put £100 into a global stock market index 50 years ago, today it would be worth over £7,000, right? That's a hell of a lot of compounding. That's a hell of a lot of growth. But what if you'd been taking the safe route? What if you'd taken the safe route and maybe put it into a high interest savings account? £100 into a high interest savings account 50 years ago, just in cash. That wouldn't have even reached £2,000. That's the value of what some perceive as safety. It's a huge thing. It feels natural to want to act when markets crash, and I get that. We're wired to react to danger even when we don't understand why the thing is in danger in the first place, right? We're wired to do that. But the data, not me, the data shows that riding out the dips, staying in the market works. It works over the long term. You can't dispute data. You can dispute feelings, but you can't dispute data. Well, not data that's widely corroborated anyway. And I'll back it up with Vanguard research. Vanguard have done some research recently. You can probably find it if you search for it on Google. And it shows it very clearly that investors who stay out of the market, trying to dodge the dips, do worse financially than those who stay in, even through the toughest times. Trying to time the market means missing the best recovery days, and that can make a huge difference to your long-term returns. Right? I mean, let's think about 2008, 2009, the financial crisis. If you'd sold at the height of the market before that financial crisis hit, before the stock markets plunged, you'd think you might have lost quite a lot of money. But if you'd kept all that money in, you'd kept investing, you'd kept your investments on track up until today, not only would your money have recovered, not only would those losses that you saw on a screen recovered, you would have made far in excess now in 2025. in 2025 at the height. So this is you not selling at the top of the market, staying in, going through the losses, going through the recovery as well, and all the growth that came after that. Now, isn't that worth staying in for? This is how I'm staying resilient. So you get a view as to how I'm viewing the market. When the headlines get noisy, I remind myself that this is normal, right? It's normal. Turbulence is normal in the stock market. It always has been and always will be. This sort of thing has happened before. Despite all the stuff you hear in the news about Trump and tariffs, tariffs have happened before. Governments have put tariffs on each other's imports before. This will happen again. It's not the only time it's going to happen. How did you think when the financial crisis hit? How did you think when the pandemic hit and the stock markets crashed? Similar things happen all the time. Markets carry on their long-term march forward regardless. The way I tell people about stock market investing, if you had the 500 top CEOs and board of directors and all the staff in those companies, if you had all of them working for you day in, day out to make money, to grow their companies, to grow income, to grow revenues, and they did it for you, wouldn't you want a part of that? That's what stock market investing is all about. If you put your money into the stock market, into an index fund that has low fees, you are going to make money over the long term. That's what the data shows. My job isn't to guess every twist and turn. It's to stay focused and keep building my investments over time. I'm planning to do more of these lives alongside my other videos over the next couple of weeks. So if you found today's live helpful, tell me, let me know by liking and sharing it. It really does help. And you never know, a simple gesture like sharing it on your socials or with someone you like, someone you love and trust, could really be the thing that helps someone else stay calm, stay invested, and change their financial future for the better. Thanks for tuning in, and I'll see you on the next one.